I think that's right. There's been a huge amount of economic change in the last few years. And even now, we're still in a phase where we are emerging from COVID in many economies and still experiencing the effects of what COVID brought upon us in terms of inflation in particular across the world. So, when we're talking about the winners from last year, it was often US exposures and dollar related beneficiaries. Those are the ones that are likely to suffer the most this year. Whereas the winners, as you said, are often the laggards. So the airlines you've mentioned, some of the consumer staples who still have pricing power into this environment, and obviously all of those companies that are exposed to China, because we've still got this very unsynchronized cycle where we've got China rebounding from very weak growth of the last couple of years, and the US sliding from very strong growth in the last couple of years. And European equities with exposures to both of those regions are very much stuck in the middle and being buffeted in both directions.
I think you make a very interesting point about pricing power, and that is the sort of Jekyll and Hyde aspect of this fight against inflation here, because as we watch the earnings report cards come in, it's clear that companies have benefited from being able to lift prices under cover of the higher headline inflation numbers. If we continue to see headline inflation come down and then maybe core start to follow, do you think ultimately we will see corporate margins begin to fall quite aggressively? And what does that imply for stock selection?
It's definitely true that in general, when you get a strong rise in GDP, which generally leads to a strong rise in revenue growth, it's that acceleration in revenue growth that allows for margin expansion. And then there's this topic that's going around policy circles at the moment of excuse-flation, that companies really had every excuse to expand their margin. That's definitely dissipating. And obviously the reverse is true. Operational leverage works the other way. So if you have revenue growth that is slowing, even if it's still positive, that can still produce negative earnings growth, which is our expectation for Europe this year, just because you get margin contraction into a slowing revenue environment, even if revenues never go negative. But the nuance is that there are some companies in unusual places with still very strong pricing power. Luxuries might ordinarily be considered cyclical, but with the amazing demand we're seeing from Chinese consumers and the travel we're expecting in summer, we think they have amongst the best pricing power and potential volume growth for the rest of this year. Banks too, an unusual place to consider having pricing power, but in a rising rate environment, they've got incredible pricing power. So it's a very unusual cycle where you don't necessarily want to hide in the most defensive stocks that you would typically consider to have the strongest pricing power in a recession. Because as much as the world is slowing down, it's not slowing down evenly, and in fact, there are areas of acceleration.
Gerry, where's the crash? I mean, you guys over at UBS are talking about 20% plus lower for the S&P, well over 10% lower from current levels for the stock 600. I'm just not seeing the catalyst at the moment. If anything, these markets continue to be very graceful on the upside on the back of the earnings season, on the back of what's going on in the macro, rather than because of it going down.
Yes, and we're seeing that in the company reports as well, whether it's in the US or in Europe, that companies are still able to maintain a lot of their ability to price this inflation into their revenues. So we have not yet seen a significant fall in margins, but that's not to say they aren't coming down. In the US, they've come down quite materially already. In Europe, they're also sliding into this weaker revenue growth environment. We just haven't hit that inflection point where profit margin contraction, which at the moment is coming on very, very high levels and is not yet even back to previous peak cycle margins, reaches a non-linearity point. The non-linearity point is very, very late in the cycle when you actually get the lagging indicators like jobs starting to turn around. So only in the last few weeks, last few months really, have we started to see initial jobless claims and continuing claims in the US to rise, but we've still got non-farm payrolls that are materially positive. So it's very, very important to watch. For example, we've got nowcasts that come out towards the end of every month. Very, very important to watch those to give us a little bit of a lead on some of the data on a very short-term basis that will give us an idea about when this very rapid tightening in financial conditions reaches the inflection point that produces some non-linearities that accelerate this earnings decline we're expecting.